Hello everyone, welcome to another episode of In Conversation by Advisor Coach. Today in conversation, our guest is Mr. Vinay Paharia, CIO Mutual Funds with PGIM India Mutual Fund, and Mr. Vivek Sharma, Senior Fund Manager Equity with PGIM India Mutual Fund. Welcome Vinay once again to In Conversation, and welcome Vivek as well.
Thank you. Happy to be
Thank
with you.
you.
So Vinay, we've heard about the Pavlovian approach of investing and how when investors use this approach in their investor behavior, often seen this style of trading failing. You recently written a note on this as well. Could you take our viewers more about the Pavlovian behavioral trap of investing?
Sure. So actually, this is a particular sort of behavioral challenge, which is sort of a trap for investors, and they should be very careful about it. So what it is all about? It is nothing but a conditioned response. Ivan Pavlov, just to give you a background, he conducted an experiment few decades back on his dog. And what he did in simple words is before he fed the dog with food, he rang a bell. Right. So there is no connection between bell and food, but whenever the bell rang, the dog saw that it was fed food. And for the first few days, nothing happened. The bell rang and he was fed the food. The dog did not respond in any which way. But after 10 days or 15 days of consistently doing this, the dog started behaving in a very different manner. With every ring of bell, he started believing that he will receive food and he would start salivating. So with every bell, the level of saliva increased with every passing day, such that now the bell meant food. And this is what conditioning of responses is all about. We as human beings also respond very similarly, specifically in stock markets. In the last 4 years, we have seen almost 80% of the current investors join the stock market investing bandwagon, so to say.
Yes. Yeah.
So they have seen markets for the last 4 years. And in the last 4 years, when we analyze data, what we saw is that BSE 500 on a monthly basis, there were about 40 periods or 40 months in which the index delivered positive return of average of 4.3%, and just 15 months in which it delivered a negative return of 2.6%. So there are two observations. The number of months in which the index delivered positive returns was significantly high, which meant that investors always saw that the index kept on doing better and better every month. And with each passing month, they also saw a significantly higher return. So now they started getting conditioned that whenever the market fell, to them it appeared like an opportunity because the markets will rise. Right. So what they have seen is that with every fall, the markets kept on rising. And this is what I call as the conditioning. Investors have been conditioned to keep buying the dip. And if we look at the data, that clearly confirms this behavior. In the last 4.5 years, whenever the markets have fallen by, let's say, 1% or more, investors have invested 2 times more money than what they would have invested when the markets have risen. So I think that is what I meant by the conditioning. Investors should not fall in this trap. They should invest based on their advisor's advice, which is ultimately based on their goals, and not invest based on these behavioral traps, which can ultimately result in suboptimal outcomes for their investments. So I think that was the context.
And yes, you're so right, because we've seen in the past, every time the market dips, there is a lot of investments flowing in, and then again there's a dip, and of course then this kind of becomes like a trap, which stops operating in a positive manner.
Absolutely.
So Vivek, we have seen a lot of drawdown in the mid caps and the small caps, of course. So particularly, what is your view and what you believe are the attributes for these drawdowns in the mid cap? And what changes have been made in the mid cap portfolio? Also, you continue to hold the value strategy over the growth strategy still in the portfolio?
So Suren, we have seen some drawdowns in the mid caps and small caps, but to my mind, the drawdown is fairly small when compared to the kind of returns that we have seen over the past 15 quarters, 15 months, or specifically from COVID lows. Why did this have? Why we are seeing some correction or some drawdowns is there was a too much exuberance in certain pockets, wherein there were certain pockets of the market where unsustainable valuations were given to historically slower growing or low return generating businesses. It is true that some of these businesses did see an uptick. However, this uptick to our mind were more cyclical in nature, and you give high valuations to companies that are expected to grow sustainably over the longer period of time, not to cyclical companies that are expected to grow well for a smaller period of time, and then earnings generally tend to fizzle out. However, in this exuberance and in this rush, as Vinay pointed out earlier, that markets were going up, the market seemed to have assigned very high valuations to some of the cyclical or slow growing companies. So that is, to our mind, is seeing some bit of reality check that we are seeing the correction in some of the mid caps and small caps. Does it mean that all mid caps and small caps have the same flavor? No, there are still reasonably good enough medium to longer term steadily growing companies in the mid cap and small caps today also that one can build a portfolio. However, we should, as a portfolio manager, we should avoid the pockets wherein there is a lot of euphoria, optimism built in, but and valuation is factoring in a lot of growth, which may or may not come. To secondly, as you pointed out, we PGIM as a house are growth investors. Our philosophy is growth and quality. We combine these two attributes to at least form our universe for investments. So that continues. We are not necessarily value in nature. However, we are also mindful of the price that we pay, the valuations that are there. So we would like to be in the bucket wherein reasonable fair value growth opportunities exist, and not compromising on the growth and the ROE or the quality aspect of it. You also asked whether is there a possibility of a further drawdown. Yes, a further drawdown cannot be ruled out for the simple reason that let's say from the start of April 2023, the mid caps and small caps have given significant returns. Some of it justified, some of it is backed by euphoria and undue optimism. So there is a possibility of correction in some of the micro bubbles that we see in various parts of the market. But overall, if I am a medium to long term investors, and if you stick to growth and quality investing, I don't see there is a problem for the medium to long term.
Sure. So you continue with the growth as an investment strategy post drawdown market corrections as well. So Vivek, let's say if, and this question is not particularly for your mid cap, but if someone has a larger sum to invest today, correct, and wants to invest into mid cap, so would you advise more of a systematic transfer plan or a staggered investment, or would you say, okay, no, this is the right time, just move in with the entire bulk money right now into the mid cap portfolios? What would you suggest?
See, if I'm a long-term investor, I would not worry too much about it. However, given the simple fact that, let's say, for the whole of FY24, the mid caps and small caps have given 60% plus kind of return at the index level.
Yeah.
So given this background, we also believe that we may have borrowed some returns from the future. When, how, and how much the correction could come, nobody knows. So with that background, it is always advisable to split your investments or stagger it over a period of time so that if a correction does come, you kind of average it when it comes. If it doesn't come, well and good, you don't lose too much because since you're investing anyway. So my recommendation would be to stagger it over a certain amount of time, maybe 6 months, maybe 12 months. But lump sum would be at this point of time is less preferred than staggered investment.
Sure. So one more question which comes to our mind, Vivek, is that we have index funds also on the mid cap platform. So, would you still believe that an active mid-cap fund will continue in a longer term period? Of course, I'm not referring to any short-term period. An active fund manager will be able to provide a higher alpha over the mid-cap index fund because of the the price discoveries yet to be achieved in the mid-cap space. What's your thought on that?
So while index or ETF kind of investments do have a place in an investor's portfolio, however, when you invest in a index, it has all sorts of companies, and not all sorts of companies perform in a similar manner over a period of time.
Sure.
If you look at so in the recent past, a lot of small caps have become mid caps. Some of them were let's say low growing or historically low return generating businesses, but given the price appreciation and the market cap increase, they too have become, let's say, mid caps, or some of them might have gone to become even in the larger bucket of Nifty 100, so on and so forth. So when you are investing in an index, you are not basically taking a call on the stock selection, you are taking a call on the markets.
That's true.
So that is a different ball game. For the way we approach it is that as portfolio managers, our job is to select stocks with reasonably risk-adjusted returns that we can offer to the investor. And when I say risk-adjusted, that also goes to the point of active investment, that we would avoid companies, let's say, that are have shady corporate governance, let's say, which are at abnormally high valuations, or too much let's say optimism built in, too much growth which may not fructify. In passive investments, you do not have the luxury of doing that. In active investments, you do have the luxury to do all these things. Hence, to my mind, if from a medium to longer term perspective, if you're doing the basics of portfolio investments, portfolio investing right, you will generate an alpha over the index funds or the index itself.
Sure. Fair enough. So when coming back to you, the larger question is that October, of course, as we are still continuing in October, we've seen over $11 billion of FI outflows happening. Of course, DIIs and mutual funds and insurance companies, etc., have come in buying, and so I would not say that the markets have not corrected. Of course, they have corrected, but not to the extent they would have because of the sustenance in the buying happening. So, to your mind, Vinay, how much is the geopolitical scenario which we are all going through has been factored into this, market situation as we speak? Because we are definitely in a very interesting time when we're having this conversation where markets are, every day they open and they're in the red. And what do you believe? Of course, there is corporate earnings to be, also one of the reasons for that as well. And of course, now the various reports which I'm reading, they're questioning also about the real GDP for India of 7.2% or so as a question to be, correct? So what do you believe that, on a larger perspective, where are we heading?
So I think if your question is on foreign investor inflows or outflows, we need to remember that foreign capital generally behaves like water. It will flow into places wherever there is opportunity to flow.
Absolutely.
Right. So they would want to seek the best opportunity for that capital, and they are not locked like us. We are domestic investors, and we do not have complete capital account convertibility, and hence all the domestic capital is not completely free flowing. It's also locked up to a large extent. Whereas foreign capital, it is free to move into any geography, into any location, into any asset. So if we look at that, I think first is, while there have been outflows in October, there have been tremendous level of inflows in the past few months or quarters. And if one looks at on a year-to-date basis, the level of outflows is not as alarming. Second is, I think we should not shy away from the fact that valuations are clearly elevated at this point of time. We have borrowed returns from the future. And if foreign investors are able to look at and identify markets or individual opportunities where potential returns are better, they would want to move to those places. And I think that automatically acts like a leveler, right? Because for every buyer, there has to be a seller. Otherwise, there would be asset bubbles.
Absolutely.
So I think this is this is what is happening currently in the markets. We should not worry too much about the liquidity events. What we should be worrying about is whether or not we are buying assets at a reasonable price, such that future cash flows justify the valuation which we are paying today. So I think we should be more worried about the entry valuations, the potential for individual investments, so on and so forth. If there is opportunity, foreign capital will definitely come in.
Sure. Sure. So Vinay, of course, yes, you rightly said, and I really like the statement what you made that we have borrowed the returns from the future and factored them already. That's the reason we've seen some returns, happening in the past. But how much of the geopolitical activity has been factored into the current market situation, to your mind?
I think the fact of the matter is that we have seen big wars which have been happening in the last couple of years, and we had experienced COVID pandemic in just 4 years back. So when we look at all of that, the returns which investors have made in during all of these challenges is far more phenomenal than what could have been imagined by people before 2020 happened.
That's so true.
Yeah. If someone thought and told you that sitting in 2019 that in the next 1 year you are going to see pandemic where everything is going to be shut down, Israel war is going to happen, then we are going to see Russia-Ukraine war, which is going to happen. I mean, hell would have broken loose, right? But what has happened fast forward 5 years? We have seen 20 to 25% CAGR returns for not only Indian assets, but also global assets.
Yeah.
I think uh, geopolitical situation, it is fragile, but at the same point of time, it has not impacted either ways the asset returns. Nor has it impacted economies materially, except the isolated economies of, let's say, Israel or Gaza or Lebanon or Russia, Ukraine. But beyond these localized level of impact, we are not seeing a material global impact, which is why asset prices have not materially reacted. And having said that, I would say that we should be looking at geopolitical events, but economics are far bigger drivers of asset prices than geopolitics at this point of time.
Sure. So you continue to believe that the overall India story continues to be intact, and as an economy, of course, there are noises all around. What's happening? Anybody who's coming from a long-term investment perspective should continue to believe in India's story to create a long-term wealth.
Absolutely. I think the big picture, if you were to ignore what is happening in the stock market, the big picture is that there are lots of positive developments from a long-term and medium-term perspective for Indian economy, and I think these are so solid that we can be sort of assured of materially higher economic growth over the medium to long term. So if we look at, for example, the digitization story, the exports story, which is built up purely because companies want to diversify the supply chains away from China, the Make in India thrust by government, manufacturing thrust, which is being pushed by government. I think not many things are happening on the ground, which are also percolating into individual companies' income statements and balance sheets.
Sure.
Companies are setting up real projects. They are reaping real returns on those projects out of all of these policies. So these are not just discussion points. These are not just macro developments. These are all trickling down into real companies and into real returns for individual investors. So I think we are very, very strong believers of the medium to long-term structural growth story for India. Also, very importantly, we have to remember we always had a competitor in China. China was always offering a superior growth to most investors across the globe, and China was the only game in town, and India was always the second fiddle. If you look at it now, India is amongst the only large economy which is growing at such a fast pace, has all the demographics working for it. We are a democracy. We are a government which encourages foreign investment, open economy. People trust numbers of Indian companies. So I think lots of things are going which are positive for India. And I think that is why we remain super bullish on prospects for India over the medium to long term. I think there's no taking away the fact that we will see a strong growth going forward for India.
Oh, that's fantastic to hear, Vinay. So Vivek, what Vinay said, in extending that, would you would continue recommending in current market situation the mid and small cap portfolios?
Uh, as Vinay said, if you are a long-term investor, I see no reason why you should be worried.
Right.
However, one should align their portfolios to strategies which have the potential to, create better returns than, let's say, the benchmark or in general the, broader averages. How do you do that? Let's say there are two styles of investing available, which is, let's say, value and growth. As we stand today, value, the definition of value is that it is cheap. Today, nothing is cheap. So value is expensive and growth has typically been, let's say, on the optical level, on an optical basis, valuations were on the higher side. So the whole thesis of investing in cheaper stocks is not very, on a broader level, not true anymore because valuations have gone up. In that scenario, if you are paying, let's say paying elevated valuations, you should rather stick to companies that offer you a better earnings growth. Because on a earnings basis, if you are growing better, even then, if the valuation is higher versus a company or a sector wherein valuations are higher but earnings growth is low, the risk reward is clearly in favor of companies which are growing at a faster pace. So as long as you are constructing a portfolio which is comprised of growing companies, not diluting the return ratios, having good capital allocation track record, you should continue to invest in mid caps and small caps because in general they because of their size they would be faster growing than let's say some of the large caps, and that hence offers a very good long term growth opportunity.
Sure. When coming back to you, any new product launches being planned?
Sure. So I think we are a full service asset manager, and we would be over a period of time completing the bouquet of assets which we can, or funds which we can offer to investors, which offer our unique investment capabilities. So in the last 1 year, we have already launched PGIM India Large and Mid Cap Fund, the Retirement Fund, and the Multi Cap funds. So we are incrementally considering launching certain themes which we think are more structural in nature and are not temporarily attractive. So whenever we launch a thematic or stroke a sectoral fund, we would want to ensure that we attract investors from a long-term perspective, so that it's not just a temporary pop which investors play for, it's a long-term structural opportunity. So yes, we have filed for certain products, and we plan to launch a few of them in this calendar year itself.
Wonderful. So Vivek and Vinay, through this in conversation, what message would you like to give to the mutual fund distributors, the investor advisors, and the investors? Would love to hear both of your thought process.
Sure. So I would keep it brief. So the first message which I would want to give investors is that make no mistake, we have borrowed returns from the future. So markets are trading at elevated valuations. Please lower your expectations of returns from equity investments and consult a qualified financial advisor to invest based on your goals and not based on instincts. Having said that, there is a particular type of an opportunity which is available in the market even today. So what we have seen that over a long period of time, in the last 25 years of Indian markets, where we have studied, companies which have higher growth and higher quality have delivered substantially better returns compared to companies which have got lower growth and lower quality. And this has been worked over the last 25 years on a rolling 3-year basis. And the chances of you delivering a superior return in a high growth portfolio is almost 2 out of 3 times. Having said that, in the last 1 year, starting from April 2023 right up till June 2024, or 14 months, we saw the high growth companies substantially underperform the low growth companies. So much so that there is a huge opportunity which has opened up. So just to give you some numbers, in the last 14 months, from April 23 to June 24, high growth companies underperformed the low growth companies by approximately 35%.
35%.
Yes. This has now started to turn post the election results. And we have seen from June 2024, market tide consistently turning in favor of the high growth and high quality companies again. So much so that now the growth companies have outperformed the low growth companies by approximately 12%. So 35% underperformance in the previous period, 12% covered, but still a long way to go. We would say that there is an opportunity which has opened up for investing in high growth companies in the near future. And I think these are companies which adequately capture India's potential growth, which is in front of us. So I think that's an opportunity, and we would recommend investors to look at that area.
Sure.
Over to Vivek.
So my message or advice to investors, advisors, distributors would be do not view markets as a short-term phenomenon. Serious wealth is made when you invest for the long term. Equity as an asset class is more volatile in the short term versus the long term. Long term, the volatility goes down significantly. So this is a long-term relationship which we should enter into, and then you derive the most of it. The markets are not a casino. We should not treat it as such.
So true.
I mean, there are so many short-term products available on the derivative side. Those are, it's a matter of luck and chance rather than, let's say, your investment behavior or your prudence in investing that determines. That should not be the mode of investing in the equities market. And as Vinay also alluded to the fact that we should not get carried away in the euphoria narratives, stick to where growth and profitability, visibility, surety is. Keep investing in companies that have a good management, good capital allocation track record. And if you do this, you will avoid the major mistakes. And as long as you avoid the major mistakes, I think one investor should be reasonably well off when compared to, let's say, the broader markets. So that would be my message and advice to the investors.
And I would just add to it that do not get into the Pavlovian behavioral trap. Very, very important.
Absolutely.
That's a very good one. And well, for the viewers, this is Mr. Vinay Paharia and Mr. Vivek Sharma from PGIM India Mutual Fund. What is very, very important and credible today is that in the markets the way they are, coming out and discussing as to what their thoughts are, continuing to believe that the growth strategy continues to be a far better strategy in the long-term periods, and about their views on the markets. I think this is exactly the conversation we were looking for. So thank you, Vinay and Vivek, for joining in today, because these views are needed by the advisors, by the mutual fund distributors, as well as investors. So thank you for taking our viewers, across through what you believe the markets in the near and the long term are going to be providing to us. So thank you once again for joining in today in a conversation by Advisor Coach.
Thank you. It's been a pleasure.
Thank you.
Thank you, Saren, for having us on the show.
Our pleasure. Thank you very much.